Martin Towns, you are Deputy Global Head of Real Estate at M&G. Thank you for joining us on BiTV.
Pleasure. Great to be with you.
M&G Real Estate's mid-year outlook report suggests that after a challenging couple of years for global real estate, there's a greater sense of optimism associated with the rest of 2024 and beyond. How do you explain this positive sentiment?
I think the first thing to point out is that inflation is moderating. We've got relative stability in interest rates. And at the same time, real estate values have rebased. And it looks like this year is likely to be a turning point for most capital markets. At the same time, we've got long-term structural trends that investors can tap into. So further urbanization, we've got demographic change, and that's fueling demand for housing and it's fueling rental growth. So that's one example. But we see rents rising in real estate across much of the globe. So we've got this sort of positive dynamic on the occupier side, on the rental growth side. So I think all those things combine to mean that investors can have more confidence in putting money to work in the real estate market. So look, overall, we think 2024 could be a turning point in most real estate markets.
All right. And in the report, you called this new cycle a new cycle of contrast. And therefore, I was curious, how does that new cycle of contrast compare maybe to other cycles from the past for real estate investors?
Sure. So look, if we compare to the previous cycle, and when we look back at that, we see that a lot of that cycle was driven by interest rates getting lower and interest rates being lower for longer. So in many ways, it was like the tide that was lifting all boats at the same time. And yes, we had some sort of structural trends happening. So we had the shift from physical retail to e-commerce. That was bad for retail generally, but it was good for logistics. But the biggest force at play was really what was happening with interest rates and therefore cap rates. If we contrast that with where we are today and what we see today, firstly, we've had, as I said, inflation and higher interest rates that shifted real estate values. Now, that period of adjustment as a consequence of higher rates is probably behind us or largely behind us. So looking forward, we're looking at returns coming from higher income yields and then income growth as well. So that's one contrast, if you like. The second one is when we look at the occupier markets today. So really, they were shaped by COVID in terms of how we live, how we work, and it also accelerated demand for things like, just-in-time delivery of food, or it really brought into focus the point around sort of well-being and experience in buildings. So occupier needs are changing. And then additionally, we've got limited stock of the types of buildings that are in demand, because another feature of what we've experienced with higher interest rates was we also saw higher construction costs. So we've seen less development coming through to meet those demands. So I think going forward, what drives performance from real estate is going to be a bit different. And you're going to see contrast between different sectors, and then contrast between individual buildings as well. So I think for us as real estate investors, we have to be aware of and tapped into these long-term structural trends, some of which are global in nature, but we also need to be very well tapped into what's happening at a local level. And that's where having a presence on the ground with local people is really important.
And you talk about contrast depending on sectors. Obviously, I have to ask, in Europe, which sectors do you see maybe benefiting most of this new market environment? What are your convictions for the rest of the year and going forward?
Sure. Well, I think perhaps before we go into the sectors, if I may, we just talk very briefly about real estate debt. So I think on that side of things, we've seen probably limited distress so far, but there's a lot of refinancing events which are still to come over the next 1 to 2 years. and borrowers having to refinance in this much higher interest rate environment. So, look, that's going to create some challenges, and probably traditional lenders might fail to fill all of that gap or offer borrowers the solutions that they need. So I think that's a really interesting opportunity still for institutional investors to be the providers of that finance. And we see increasingly good deal flow there. And we see attractive margins and attractive risk adjusted returns. I think moving to the equity side of the story, if we think about what we'd call directional strategies, or those strategies that are benefiting from these sort of structural tailwinds, I think we have to call out the living sectors and also the logistics sector. So, on the living side, we see a fundamental lack of supply of good quality modern housing stock in most cities across Europe. We see, particularly acute shortage of purpose-built student accommodation with, strong local demand, but particularly international demand. So we see upward pressure on rents there. And then on the industrial and logistics side, I think as a consequence of COVID and possibly, geopolitics as well, we've seen some reshaping of demand patterns, and therefore a reshaping of what logistics supply chains need to look like. So we see that opportunity really breaking down into two components. One is, your larger logistics units in logistics corridors that are in demand now. And then secondly, it's last mile logistics or urban logistics, because we've seen this continued trend for people to want things faster, basically, and so people are having to change their supply chains to meet that demand. But I think standing back, Europe is obviously a very diverse region. It's a diverse collection of countries, and that means a diverse range of opportunities. And look, I think there's probably going to be, a few more bumps in the road. I don't think it's all going to be plain sailing from here. But I think overall, the outlook is looking a lot brighter than it did, say, 12 months ago.
That's still more hope than we had over the last 2 years, so we'll take it.
Absolutely.
Thank you very much, Martin Towns, for taking the time to share your insight with us. And then thank you all also for being with us, and we'll see you soon on BiTV.